APR, liquidity, assets, bear market. Sound confusing? Don't worry, because by the end of this video, you'll be speaking the language of money like a pro. Today we'll break down the most important financial terms in a way that's simple, practical, and easy to remember. We're talking real-life examples, actionable tips, and no confusing jargon. Let's start with the foundation of your financial house: assets and liabilities. An asset is anything of value that you own that puts money in your pocket. Think of it like this: your phone you're watching this on? That's an asset. If you sell it, you get cash. Your car? That's an asset too, unless you're upside down on your car loan. Then it might be more of a liability than you realize. Now, a liability, on the other hand, takes money out of your pocket. That car payment I just mentioned, that's a liability. Your student loans, credit card debt, even that Netflix subscription you've been meaning to cancel. All liabilities. They represent ongoing costs and debts that drain your cash flow. Understanding the difference between assets and liabilities is huge for building wealth. The goal is to have your assets outweigh your liabilities. That's how you build a strong financial foundation for the future. Now that you know the difference between assets and liabilities, let's talk about your net worth. Think of this as your financial scorecard. It's a snapshot of your financial health at this very moment in time. Here's how you calculate it. Assets minus liabilities equals net worth. Simple, right? If your assets are greater than your liabilities, congrats, you have a positive net worth. Tracking your net worth over time is crucial for financial success. By setting financial goals and making smart money moves, you can watch your net worth grow year after year. Okay, let's talk about interest. Interest is like that friend who can either help you move or eat all your food. It can work for you or against you. There are two main types of interest: simple and compound. Simple interest is the most basic form of interest. It's calculated as a percentage of the principal amount you borrowed or invested. For example, if you have a $1,000 loan with a 5% annual simple interest rate, you'll pay $50 in interest each year. Compound interest, on the other hand, is like magic. It's the snowball effect of earning interest on your interest. Here's how it works. Let's say you invest $1,000 with a 10% annual compound interest rate. In the first year, you earn $100 in interest. But in the second year, you earn interest on $1,100, not just the original $1,000. Over time, compound interest can turn small investments into significant wealth. Chapter 4. Inflation, the silent wealth killer. Remember when that candy bar was only 50 cents? Yeah, me too. That's inflation at work. Inflation is the rate at which prices for goods and services increase over time. In other words, your money buys less over time. So, how do you protect your hard-earned cash from inflation? By investing your money in assets that have historically outpaced inflation, like real estate or stocks. Think of it this way. If inflation is like a leak in your financial boat, investing is like using a bucket to bail out the water and stay afloat. Chapter 5. Liquidity. How accessible is your money? Let's talk about liquidity. This refers to how easily you can convert an asset into cash without affecting its market price. Cash is the most liquid asset. You can use it to buy things instantly. A savings account is also considered very liquid because you can withdraw your money quickly and easily. On the other hand, a house is a much less liquid asset. Having access to liquid assets can give you peace of mind and financial flexibility when you need it most. Chapter 6. Time to talk about the animal kingdom of finance: bull and bear markets. Imagine a bull. It charges forward with its horns, just like a bull market. A bull market is a period of time when stock prices are rising, investors are optimistic, and the economy is generally doing well. Now picture a bear. It swipes downward with its paws, just like a bear market. A bear market is the opposite of a bull market. It's characterized by falling stock prices, investor pessimism, and economic slowdown. The key takeaway here is that markets are cyclical. They go up, they go down, and then they go up again. Chapter 7. Here's a golden rule of investing diversification. You've probably heard the saying, don't put all your eggs in one basket. Diversification means spreading your money across different asset classes, industries, and geographical locations. Diversification is your secret weapon for reducing risk and maximizing returns in the long run. By spreading your investments, you're essentially cushioning your portfolio from market volatility and setting yourself up for more consistent growth. Chapter 8. Now for the moment you've all been waiting for, financial freedom. Financial freedom means having enough passive income from investments and other sources to cover your living expenses without having to rely on a traditional 9-to-5 job. Imagine this: waking up every morning without an alarm clock, spending your days pursuing your passions, and having the time and resources to travel the world. By mastering these concepts, you're equipping yourself with the knowledge and tools you need to make smart financial decisions, build wealth, and ultimately design a life on your own terms. Now that you know the language of money, it's time to start using it. Which term was new to you? Or, which one are you going to focus on mastering first? Let me know in the comments. If you found this video helpful, hit that like button and subscribe to the channel for more money tips, investing strategies, and financial wisdom to help you achieve your financial goals. Remember, financial literacy is power, and the more you know, the more you can grow your wealth and achieve true financial freedom.